Hello Sector Watchers, welcome to the show. This is the 125th episode of Sector Spotlight for Tuesday the 3rd of May. I'm recording it on Monday the 2nd of May. My name is Julius the Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. You can find my contact details on the screen, and if you've got anything to share, I'm looking forward to hear it. It is the first Tuesday of the month, so we will be spending the bigger part of the show, almost all of the show, on going over the monthly charts. And there are some very interesting observations to make. I'll give you that as a heads up. But before we start, it's been a while since I shared some of the typical or real Dutch traditions, behaviors, etc. And for those of you who know, and also for those of you who don't know, last week, Thursday, the 27th of April, was King's Day. It's the birthday of our king. And traditionally, that means that the country goes a little bit berserk. And of course, for the last 2 years with COVID, it couldn't really happen. And I feel that the most people literally had to catch up. So, I mean, there's so much content around there, but if you just simply go on Twitter and you search for the hashtag King's Day, as I did here, you will find an incredible amount of pictures and videos and content. And I really like this one, is the comparison between how the Brits celebrate the Queen's birthday and how the Dutch, even the royal family. So this is the British royal family, and then it's almost, you gotta laugh about it. This is our king who goes to party with the people. In the middle here, this lovely lady is our queen. It's Queen Maxima. She's Argentinian by birth. And here is a prince celebrating the birthday of his brother together with all the people. And if you ever thought or forgot that Holland was a biking country, look at this. This is obviously the Royal Dutch Airlines, KLM, making the Dutch country glow. This is, if you ever wonder where we leave all those bikes, this is it. This is just an insane amount of bikes everywhere. This is the city of Utrecht, and Amsterdam is quite similar. And this is the royal family. And then this is party time on the canals. If you have a boat, you got to go on the canal and just have a party. And it was a lovely day. It was a great day. So you can imagine what happens if people go out on boats, play music and drink 1 or 2 beers. I mean, that's what's going to happen. But the funniest thing is, on the day before King's Day, that's King Night, there is a free market, which means that everybody can go out. Obviously, normally you're not allowed to sell on the streets. But during King's Day, you can. And it's become a real tradition. So in every big city, everybody is it's a big garage sale, car boot sale, etc. And you gotta admit, some people are extremely good at photoshopping. And for those of you who are not into Formula One or motor racing, this is Lewis Hamilton, and this is a Mercedes car, who obviously going through a rough time this season, and Lewis seems to be selling his car. Anyway, enough about this. Let's get started with Sector Spotlight and looking at some monthly charts. Let me start with talking you through the monthly charts for asset classes. So all these charts, I have cut them off at the 29th of April, which was the last trading day, which was last Friday. The market is open today, so some of these levels that you may be watching may be outdated, but this is what it was on a monthly scale. And I prefer to do it like this because when we would add today's price action, it would show an extra bar, and it's very tempting to interpret that last bar as being completed, which obviously it's not. We've got 19 more trading days to go, something like that. So please keep that in the back of your mind when you compare the chart that you're looking at in the show with the actual levels in the market. Now, clearly a very weak month for the S&P 500. I think it was like down 8%, 8 or 9%. And we have just about reached the support level based on the monthly chart, which is somewhere around 41.10. So when we break that level, it's not immediately, it doesn't immediately mean that the monthly chart, well, the monthly chart will be deteriorating, but it'll be crucial where the bar will close at the end of the month. So it's way too early to draw any conclusions on that. But on a monthly scale, 41.10 is definitely a level to watch. And then just above 4,600 is where we find resistance. It's very clear that the uptrend has ended. We have a lower low potentially in place, potentially a lower high, but the confirmation will come once we have a monthly close between 4110, 4100 for the S&P 500. Short version, it does not look very good for the S&P 500. For the time being, still sideways between these support and resistance levels. Uptrend, not intact anymore. Downtrend, we're very close to entering a downtrend. If we look at government bonds, then we see that GOVT, which is the aggregate index for US bonds, has reached a very important support level, just above 24 in the ETF price. If GOVT breaks below that 24 level, that'll be a very significant signal for a further decline in bond prices and a further rise in bond yields. And if we zoom in on the 10-year bonds, then you will see that IEF is very close to reaching 100, which is a very important level in IEF. Clearly, this is a downtrend, and aside from some bounces, I mean, if you lose more than 10 points in an ETF, in a bond ETF in about 2 months' time, it wouldn't be strange to see a bit of a bounce. However, the trend is clearly there, and I think that the bond market is still in very weak shape and still very dangerous. We refine it a little bit to, this is investment grade bonds, then you see that this ETF, LQD, is also nearing a very important support level. This is about 10-year support levels. This is 2012, 2013. So this level here, which is just above 110, let me add that here for you. This is like 111, 111 and a half. We're now 112 and a half. If that breaks, that's a break of a very significant support level, potentially sending corporate bonds much, much lower. And again, because of the steep decline that we had over the last, well, this is already 1, 2, 3, 4, 5, 6 months, a bounce would not be strange, but the shape of the chart is very, very weak. If we go to V&Q, it's the real estate, asset class real estate, Vanguard real estate ETF, that's still relatively well. I mean, the uptrend was ended 2-3 months ago when we dropped below that previous low. We do not have a lower high in place yet, but if the next month, the month of May, does not go above, this is the highs like 113.40, then this could be the first lower high. So keep an eye on that. Support levels to watch here is about 98 and just below 95, 94 and a half. But in the bigger scheme of things, the real estate asset class, the asset class real estate, is still relatively okay compared to bonds and stocks. Now the real good stuff is in commodities. We talked about that for ages. Here is DJP, the Bloomberg Commodity Index, and you see that we've reached an important overhead resistance level just above 40. Again, if we dip a little bit from these levels, that's not a problem. As a matter of fact, I think that would potentially give us new buying opportunities, because when we take out that overhead resistance level, which is, let's say, 41, then it's another positive sign for commodities, and we may not even see a dip and not even get a new buying opportunity or a re-entry opportunity, if you like. GSG is the counterpart, is the Goldman Sachs Commodity Index counterpart. Again, it's also running into some overhead resistance, but the longer term picture looking very, very healthy, very, very good. Better than it has been looking for probably, well, at least 10 years, 10, 15 years. Now, the real good stuff, the one that is, we've been hammering about this, the dollar strength here in Sector Spotlight for quite a while, and I think that the dollar index, dollar USD, the US dollar index, which is a basket against a number of other currencies, is at a crucial level. 104 seems to be a very important level for the dollar index. If the market is able to take that out, I think it unlocks massive new upside potential for the US dollar. And the good thing is, because it's a very long range, we can peg a price target to it. So here's that level, and you can actually see, I could have actually drawn that line much further to the left where it lines up with this low of 2002 and this high of 1999. So if that goes, and then we can project the height of that range on top of the breakout level. So if we look at that, so let's say this is 90, a little bit, so do it conservative. So this is 90, and we've got 104. That's 14 points on top of 104. That is 118, which is very close to 120, 118, 120. So if that happens, if this trend of dollar strength continues, we may even see the dollar index go back to levels that we've seen in 2001 and 2002. I think that's pretty significant. We're not there yet. We need to take out 104 on a closing basis on the monthly chart. Preferably a very convincing way of taking it out. But the trend is there. And let me put it like this. I wouldn't bet against the dollar in this time, at this moment. And then finally, if we do a quick look at the stock-bond relationship. So this is ITOT Gov, which is the broader market versus all bonds. And you can see this massive reversal, this massive big reversing candle, which embodies the complete body, engulfs the complete body of last month. So it's a big black engulfing candle, which is actually a very weak sign. So this signals that stocks are about to reverse its preference versus government bonds, and that's probably because, as we've seen in the Gov and IEF charts, the decline in Gov and IEF has reached very important support levels, which could support bonds being stable and stocks weakening further, which would turn this relationship around. And we'll see a similar picture in SPY IEF, which is also a bearish engulfing candle here in the month of April. Continuing with the monthly charts for the individual sectors, kicking off with communication services. Now, this sector has already been in a very weak shape for the last months, actually since the middle of last year, since mid-2021, and that has not changed. I mean, last month we actually dropped below another support level, which is now turning into resistance, and we're closing in on support around 192. This sector, because it was the first, is now coming close to more important support levels where we may see some improvement or at least a pause in the decline nearing. However, that won't go overnight, and we will have plenty of time to detect such pauses or stalls in the decline. For the time being, communication services remains in a downtrend and remains one of the weaker sectors. We go to consumer discretionary, obviously one of the more important sectors in the S&P 500. Look at the last 3 monthly lows. They are all lining up around 1270. I mean, that's very clearly now an important support level. So when that breaks, when we dip below 1270, and again, on a monthly basis, if you stick with the monthly charts, but even if you see this number of lows, then you can be sure that when you make this a weekly or a daily chart, it'll also show up as a very important support level. So 1270 is a level to watch for consumer discretionary, and a break below 1270 will very likely ignite further downside and push the discretionary sector. Could go to levels around 1150. The upside, obviously, because we're now so low within that range, it's quite a bit of upside. That goes a little bit above 1500, which is possible for discretionary within the range. And even then, it won't change the fact that the downtrend's been broken and we're more or less in a sideways range for consumer discretionary. Staples is quite a different story. We actually put in a new all-time high last month and a new closing high, which is very nice. It's the only sector that does that at the moment. We're holding up very nicely above former breakout levels. Support that I'm watching is around 750, just below 750. And the upside actually, well, I've labeled it here at 850, which is last month's high, but it's not really a peak in terms of monthly charts. So in fact, the upside is sort of unlimited because there's no referral materials. There are no previous highs that we can refer to on a monthly scale, at least, as being resistance. Energy continuing to do well. We touched resistance, which was offered by the highs of 2015. We've been playing around with that last month, and then this month again we were not able to break through. Again, after a rise of this magnitude, it wouldn't be strange if we see some sort of consolidation, maybe a little bit of a setback for the energy sector, but the current strength for this sector remains clearly visible, and it remains one of the strongest sectors in the S&P 500. Now, financials is kind of disappointing. If you look at this, as I said, it's closed. The chart is closing at the month end, which was the 29th, and we see a very clear break of that previous support level. That was around 585. I think that should now be watched as resistance, and this is a clear completion of a peak pattern here in the financial sector. We're not in a downtrend yet because we've have this high, and now we're penetrating that previous low, but we don't have a real lower high in place. Nevertheless, the chart looks weak, and we could even go as low as 525, which is a serious downside risk for the financial sector. Look at healthcare, one of the defensive sectors, holding up very well. We've challenged the overhead resistance area around 1650 once again last month, and we closed at the bottom of the range, which was not very strong, but nevertheless, I mean, the uptrend here, the series of higher highs and higher lows, is still in place. I think the healthcare sector is still in its range between 1450 and 1650. Currently trading, or at least at the end of last month, trading around 1520. So it can maneuver within that range without continuing the uptrend or reversing the uptrend in the downtrend, because when the healthcare sector drops below 1450, it actually completes a nice double top pattern on a monthly scale, which would be significant and weak. Given the situation of the market, healthcare being a very defensive sector, I don't think that will happen very, very soon. Industrials is now clearly weakening. You see that a lower high is in place. We have lower lows. It depends a little bit on how you look at it. We can see that this is a lower low, and this high is lower than the previous high. On the other hand, you could say that this high is higher than the previous high, so this is where it ends. You have one low, one lower high, and the downtrend is confirmed when you drop below, let's say 790. No matter how you look at it, that 790 support level is pretty significant. If we break that, we complete this toppish pattern, and we're opening up downside potential all the way back, or downside risk, depending how you look at it, to this is 716, 715, or 675. The upside, very, very limited to the area just above 900 for the industrial sector. Information technology. We already know that the downtrend was gone a couple of months ago. The lows of the previous months are all slightly lower. They're not as nicely lined up as they were in consumer discretionary. Nevertheless, the downtrend is not present because you can still see this as a decline without a new low being put into place. So it'll take some time before this becomes a real downtrend, because we do need a new clear lower high and then penetrating below wherever the low is going to be. The way I look at it is that I'm marking this here as support. That's around 24.50, and the highs not of last month but February and March, which were around 28.80. I think that's the resistance level to watch. Again, a sideways range, and because we're at the lower end of that range, there's quite a bit of upside potential, but it's not going to turn this whole image around and all of a sudden make tech one of the favorite sectors again, because I don't think that'll happen anytime soon. The risk clearly is for a further decline to the downside. Now, materials also in a sideways range. Here support is pretty clearly marked around 495, 496, 497, let's say 495, and we've got resistance at 580. Currently trading somewhere in the middle, so upside potential, downside risk, pretty much balancing out. The clear risk is when we break below this support level, because when that happens, you get all this downside, which all of a sudden is unlocked. And that could go really fast, because it's, this is also a 1 year, and it's a pretty serious toppish pattern. So when that completes, I think a lot of people are looking for the exit at the same time. And then we have real estate. We already talked about V&Q, and we spoke about asset classes. The image here is not much different. Relatively one of the better sectors, as it is one of the better asset classes at the moment. And then we have utilities, which actually put in a new all-time high, not a new closing high, but a new all-time high, which underscores the characteristics of utilities as a defensive sector. And as long as it's holding up above that breakout level, it remains one of the stronger sectors in the S&P 500, together with staples and healthcare, forming that group of defensive sectors. And then we have the S&P, and we already seen that, and here you see it again. Clearly, when we break below that 4110 area, we got a lot more downside unlocked in the S&P 500. And here is the wrap up of the position of all the sectors. As you can see, I've slightly changed the layout of my table. First of all, it's easier for me to maintain. And secondly, I've added a column for downtrends, because it looks as if we're going to see a few more in the future. And I've added support and resistance, and that, for me, that makes it easier to calculate downside risk and upside potential, because there's a few formulas behind these numbers. Staples, the only one that goes up. New all-time high for staples, as well as for healthcare and utilities. Closing high only for staples. Here are the uptrends: staples, energy, healthcare, materials, and utilities, and the only one that's really in a downtrend is communication services. So where you see two red X's, that means that there is no uptrend and no downtrend, i.e. a sideways move. And as you can see, energy has a lot of downside. The others are relatively close to their support levels. That makes the downside risk limited for the time being and the upside potential relatively big. But we've seen the charts. If some of these sectors, and I think discretionary, I think technology, will be breaking through these support levels, all of a sudden this downside risk opens up and the upside potential diminishes. So please be aware when you read that table alongside real life charts. And this wraps up Sector Spotlight for this week. Thank you for watching, ladies and gentlemen. I'm sorry we didn't get to watch any RRGs or look at sector rotation. However, monthly charts are important, long-term trends are important. So we will be back with a look at sector rotation and how all that fits in the economic cycle and the individual charts in a new episode of Sector Spotlight next week. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern, and I hope to see you again at a new episode of Sector Spotlight next week, same time, same place.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.